A bit of a snoozy morning so far. Let's see if that changes. Trying to bounce back from yesterday. Live from New York City this morning. Good morning, good morning. Your equity market positive by 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, a 1-2 punch puts an end to an 8-day winning streak as a very sloppy bond auction spooks investors. And Chair Powell says we're ready to hike if needed. We begin with the big issue, a volatile bond market.
We all want more stability in the Treasury market.
Need for a little bit of a stability of yields.
Having 8 to 15 basis points moves every day as something regular is not good.
10 basis point days in the Treasury market seem to be, a snooze. It happens all the time.
The Treasury market is central to so many other markets.
The yield volatility that we see in fixed income has been driving a lot of what's going on in the rest of the markets.
Going forward, there's a lot of issuance that has to be done.
The distribution of risks have changed.
We have a tug of war that we're going to see playing out between issuance and between a softer economy.
Still really a good chance that we're going to see a lot of volatility.
The further out you go in the curve, the greater volatility you're going to see.
Volatility is going to be the key throughout most of 24.
There's still a lot of underlying tensions in that bond market.
Let's talk about that tension. Joining us now to discuss is SocGen Subhadra Rajappa, PGIM's Greg Peters. To the both of you, thanks for being with us. Subhadra, let's start with your own words. Why are bonds so unhinged?
I think yesterday's auction definitely caught everyone by surprise. It might be because of factors that are outside the control of the markets. But even outside of that, leading into this week, my biggest concern was that there's a lot of supply that the market has to absorb, and the liquidity in the market was relatively poor. And the question was if investors would actually show up to take down the auction. We've had 10-year auctions tail for the last several auctions. The 30-year auctions have been weak as well, but again, it's a question of the fact that it's not just about this week's auctions, but also increasing sizes for the next 6 months or so. At the next refunding, we're expecting larger issuance sizes for 10-year and 30-year bonds. So this sort of problem is here to stay and needs to be addressed as soon as possible.
We had a big rally coming into this week. Greg, we moved on a 10-year from north of 5%. We dropped below 450 early this week on a 10-year maturity. I've been asking, Greg, I'd love your response to this. Have we confused the recent rally with stability?
Yeah, I think the market just continues to lean the wrong way. And so at any point in time, the response is Fed cutting, rates rally, and I think it misses kind of what's going on. And so the auction tail was just kind of representative of, 50% retracement, shakes out a lot of, demand. And so, the response was, pushback. And so, I think the market just continues to kind of think through this improperly, and always pushing rates down at any point, I think, is a mistake. So vol's here to stay, Jonathan.
Greg, how do you think we should be thinking about it?
Well, so I think we should listen to what the Fed says, and I think what catalyzed the move yesterday, the auction clearly exacerbated it, was Powell's comments reiterating what he said all along. But the market continues to disbelieve this higher for longer, that they're vigilant around inflation. The market wants the Fed to cut at any time that there's room for that commentary to come through. So I think you listen to the Fed, and that means rates are higher for longer.
This is what I hear from Citi as well. Over at Citi, Andrew Honhorst writing the following this morning: the Fed's on hold, and the bar to hike will likely not be surmounted even by the upcoming 3 months of stronger core inflation data. There's almost a sense of disbelief right now, Subhadra, around the Fed speak. There is just this overwhelming belief this Fed is done and won't respond to hot inflation data, even if we get 3 months of it. What's your take on that?
Well, I think the concern, at least in the bond market, is that the Fed has already hiked a lot. They've told us that long-end yields have gone up quite dramatically. Term premium has risen as well. And the rise in term premium is really doing the Fed's job of tightening financial conditions. So they kind of told us that they're not really thinking about hiking aggressively from here on, given the fact that the rise in term premium is doing the job for them. The real concern right now is that if financial conditions do ease, we saw 10-year yields and 30-year yields decline by nearly 50 basis points in the last week, then the tightening of financial conditions becomes easing of financial conditions. In that sort of scenario, the Fed would have to then hike rates to counteract the easing of financial conditions, and then it becomes a little bit of a vicious cycle. So that's really the bigger concern for the Fed, and that's why we saw this sort of pivot into much more hawkish speak yesterday from Chair Powell.
We've had a week full of Fed speak. We've got some more for you right now. Atlanta Fed President Bostic speaking. Inflation is too high. Must do all we can to get it down. Mike McKee, the Federal Reserve, on repeat.
The Federal Reserve is on repeat. This whole week has kind of been like listening to your mom saying, boys, stop wrestling. Don't make me come up there. That's Jay Powell's message yesterday. Don't make me come up there to the bond market. He used the same language he's used before, but just stacked it in such a way that it appeared hawkish. A long way to go to the 2% target. We're not confident rates are sufficiently restrictive. And we're going to be cognizant of the risk of being misled by a few good months of data. In other words, we're still keeping a rate rise on our table. Now, did it do a whole lot? Not really. You can see this is the week of trading in the Fed funds futures for June. The market moved up the idea of a rate cut to June after the Fed meeting last week and then the jobs report. And Powell retraced that a little bit, but it's coming back down again here. The market, as Greg Peters says, is not listening to the Fed. But of course, if you're the market, you need somebody to buy your securities, and that was the other half of the problem. Look at what happened yesterday with the 30-year. These are the stats. You know the story. Stopped through at almost 4.7%, a 5.3% basis point tail, rather. Low bid to cover ratio, and primary dealers had to take down the most in 2 years. It was basically called a dismal auction. People did not want these securities at the prices that the government was hoping they would pay. Now, does that make a big difference, or does Jay Powell make a big difference? It was clearly the auction. You can see the movement in the 30-year yesterday from the auction, and then Powell a little bit later, just kind of the cherry on top or something like that, not really making a difference. So going forward, is the market listening to the Fed, or is it going to take the market telling the market in the auctions that something needs to be done?
Close the door. That's what I thought you were going to say, Mike. Close the door.
Well, yeah, close. I mean, he did have some good advice for the security people at the IMF.
Close the door. Mike McKee, thank you very much. Enjoyed that yesterday, that's for sure. Let's go through the curve together. 2-year, 10-year, 30-year. 2-year right now, 498. Yesterday, a close above 5% for the first time this month, which also coincided with the first down day for the equity market for the first day in November. On the 10-year, we're down about 5 basis points this morning to about 457. 30-year, 472. Difference between the 2 and 10-year right now, that spread about 40 basis points. The 2 and 30-year, that spread about 27. Let's talk about that if we can, Greg. Why you think the shape of the curve should dictate where you want to be. Just explain that for us.
Yeah, so I think the shape of the curve explains everything. So why would you see tremendous demand in auctions or secondaries when you still get a higher rate to be in cash? And so if you bite down on this notion where the front end's going to remain higher for longer, inflation is above target, growth is actually pretty reasonable, why should the curve be inverted? And so I think it's quite fundamental. I don't see demand really coming in until you have a normalized curve. And so it's not as inverted as it once was, but the data has kind of supported a much more normal curve. And honestly, I think you need to see, a positive reading, 2s, 10s, 2s, 30s, really to entice investors into the marketplace.
Subhadra, is that your view as well?
Yeah, no, I agree with that. And part of the reason why the curve's been this inverted this time around in this cycle is because of the fact that the Fed's been holding a lot of treasuries in its portfolio and it's gradually unwinding its portfolio. So the buildup in term premium is happening, but it's not happening as fast as one would expect in any sort of a cycle. So So I agree with Greg. I think that it does make sense for some amount of term premium to get built into the long end to entice investors. So on a duration adjusted basis, the 2-year, even the 5-year part of the curve looks very, very attractive to investors. And that's really where you're going to see a lot of the demand for treasuries. And of course, there's a lot of bills as well. So you're seeing money market funds come in and participate in the very, very front end of the treasury curve. So it's all much more focused on the front end. So the long end is really struggling.
To that point, Greg, do you have a bias on how you think the curve should steepen? Is it the 2-year yield coming in, the 30-year breaking out? Which one is it?
Well, so the answer is always a little bit of both, but I think it has to be more back-end driven. So I do think there's some scope possibly for the Fed to modulate rates into next year slightly. But I do think if growth remains, reasonably strong, inflation remains above target, I think that back end does most of the work. So, so I see more volatility, 10s through 30s, well into the future as a result.
You're not alone. I heard the same thing from Mohamed Al-Erin yesterday. Greg Peters, Subhadra Japa, sticking with us. We're about 20 minutes out from the opening bell. Equities on the S&P 500 positive here by 0.4%. Let's get you some movers. Here's Abby.
What makes that interesting, the fact that we have futures higher, John? We have tons of big laggards to the downside, but let's start out with a couple of leaders helping out the futures, including Apple, which is higher on perhaps the news that they're set to appeal the App Store's inclusion in EU dominance. Rules are basically filing a challenge over digital markets, the Digital Markets Act in EU court. Coinbase and many of the other crypto stocks higher with Bitcoin, and a big piece of this has to do with BlackRock's new Ethereum ETF to be listed on the NASDAQ. As for those laggards, there are so many big ones, but they don't have big weightings to the indexes. Plug Power being just one example, down 37%, the worst day in at least a year. They put up a weak third quarter. 2 analysts downgraded them. Some of them are saying that there's going concern risk here on high cash burn. The stock, though, John, this is not coming as a surprise to everybody. It had been a $70 stock back in 2021. Into this print and this 37% slide, already down more than 90%.
Brutal. Abby, thank you. More from Abby around the opening bell. Coming up, a cyber attack disrupting the U.S. Treasury market.
We haven't had something like this happen before. It seemed like the when-issued market was okay going into it. There were a lot of questions because we've had such a big rally at the long end.
The world's largest bank falling victim to a ransomware attack. That conversation up next.
We haven't had something like this happen before. It seemed like the when-issued market was okay going into it. There were a lot of questions because we've had such a big rally at the long end. You started to get the Powell comments, and then you got the hack, whatever that may have had to do with it. But we'd had such a big rally going into it after the 10-year went well and the 3-year went well. I think that had something to do with people stepping back.
What a strange 24 hours in a bond market. Now, we learn that ICBC, the world's biggest bank, hit by a cyber attack, leaving the Chinese bank unable to clear U.S. Treasury trades and forcing employees to send settlement details through a courier carrying a USB stick. A spokesperson from the Treasury Department saying this: "We're aware of the cybersecurity issue and in regular contact with key financial sector participants. ICBC is now conducting an investigation." Joining us now for more is Shonali Basak. Hey, Shonali.
Good morning, John. This is certainly a nightmare starting to come true for the market. Remember, when you think about the Treasury market, it is surprisingly opaque with a lot of bilateral dealers that people look to. And ICBC in the last 5 or 6 years has gotten much bigger. It's China's largest bank and the world's largest bank by assets. But really, the real fear here is not just about ICBC. It's the idea that this could happen to anyone. We saw this week that the ICBC ransomware hack really suspected by the Lockbit gang, which is is a criminal ransomware gang that is quite sprawling with ties to Russia, but really with ties around the world to different hackers. We also know here that it really did impact the Treasury market in real time this week during an auction that was also already sensitive in and of itself. We have a lot of vulnerabilities when you think about the way debt is being issued, and that longer end of the Treasury curve is of critical importance here. And we did see demand come down on the heels of this attack through one dealer. Now, when we look at ICBC as well, we have to remember that the SEC is trying to change its rules. It's trying to make clearing more centrally cleared. But one of the worries and the counter argument to doing this here is, what if a centrally clearing agent, the DTCC, for example, gets hacked? There you have bigger issues when you think about the plumbing of the financial system. We've seen in fits and starts hacks like this before. For example, a electronic trading firm based out of Europe, really impacting the derivatives market this year. But if you look around everywhere you go, the financial industry is very concerned about more of these hacks. What if the Fed were to get hacked? What if the DTCC were to get hacked? What does that mean for really gumming up critical infrastructure in the financial system? As we saw yesterday, it affected prices in real time.
Really, really important question. Sonali, thank you. Back with us for some final thoughts. Subhadra Japa, Greg Peters. Greg, it's really difficult to answer this question. Just what we saw yesterday in terms of the Treasury market, how connected might it be to the struggles of ICBC? How difficult is it, Greg, to answer that one?
Well, I just think it was a perfect storm yesterday. There were, so many issues at play happening all at once. That was one factor. Clearly, the integrity of the system is never something you want to question. But this is why regulators are laser being focused on central clearing, particularly around repo. There's implications around that, so it's not so easy to fix necessarily. But yeah, it was more of a perfect storm yesterday than one just single event.
Greg, one thing I'm looking at right now is maybe a little bit of stability on the screen at the moment. But stability these days is like 5 basis points in either direction. Greg, do you think we have to get used to just bigger moves in the Treasury market, given what we have seen in the last few weeks?
I think so, right? I mean, so volatility has been running well above trend. It's not as high as it was, 6 months ago or even a year ago, but it's still, quite high. And so this is just the environment that we're in, right? So we're funding very large deficits. You have, less liquidity in the marketplace. You have a data-driven Fed and central banks across the world. And, these powerful moves are something that we have to get accustomed to. So what are the knock-on effects? I don't think we fully know the answer yet, but I don't think it's necessarily positive.
And yet clients still want price targets, Subhadra, so let's go through them. 450 for year end, I believe it was. Is it 375 into next year? Is that still the call from you and the team, Subhadra?
Yes, I think that 10-year yields are probably going to stay in and around 4.5% for the remainder of this year, because the data that we're expecting is going to be relatively strong in the fourth quarter. Nothing that would suggest that a recession is imminent. But then going into the first quarter of next year and the second quarter, our economists actually have a recession penciled in for the middle of next year. So under those circumstances, as the weak data starts to trickle in, perhaps even as early as the fourth quarter, but really in the first quarter of next year, then you should start seeing yields continue to decline from here on. But the liquidity profile is very important. The fact that the market is really pushing back on taking down the supply is another key component. Really, the big picture issue in the events over the last 4 hours is that we've had a lot of supply, and we are going to get a lot more supply.
It's a snoozy morning. Nothing snoozy about the last 24 hours, that's for sure. Subhadra, Greg, thanks for being with us this morning. We can take a break now. The New York Stock Exchange and the NASDAQ observing a moment of silence in remembrance of all those who have served in honor of Veterans Day. We are a little more than 6 minutes away from the opening bell. Equity futures with a bit of a lift here on the S&P 500, snapping back, bouncing back from yesterday's losses. On the S&P higher by about 0.4%. That's some of the price action. Let's get you some morning calls. Your first one from BNP, downgrading American Airlines to neutral. $12 price target, seeing continuing macro and cost headwinds. Your second call from Baird, upgrading Toast to outperform, expecting shares to benefit from strengthening revenue growth. That stock is up by 2.66%. And finally, Barclays raising its Groupon price target to $7 despite missing on earnings, applauding management's recent turnaround efforts. That stock this morning is down by 27% and getting absolutely hammered. Let's stick on the earnings, shall we? Better than expected results fueling Disney's best day of gains in nearly 3 years in yesterday's session. Abby has a couple of other media stocks this morning. Hey, Abby.
Hey, John. Yeah, it was an impressive day for Disney yesterday on that strong quarter and the outlook of cost cutting. But today we have a leader and a laggard, starting off with the stock that is down just a little bit, but well off of its lows. News Corp had been down into the print, down 6%. On the Bloomberg terminal, it's showing down just about 0.3% or so. They put up a top and bottom line beat. They put up adjusted earnings of 16 cents, better by 37%. They also put up better revenues of $2.5 billion. This is, of course, the parent of the Wall Street Journal. Well off of those lows, and on the year, not so shabby, up 17%. But take a look at Lionsgate, up 7.5%, a robust quarter, standout $133 million worth of free cash flow, in part because of the strikes. Stars and studio helped as well. This stock, John, up 59% on the year. So when you think about Disney, which did just put up that good quarter, but down on the year, maybe there's some catch-up potential for Disney, given the fact that their results seem to be improving, cost-cutting, and the media space overall doing really pretty well on a year-to-date basis.
Cost-cutting a big factor there, that's for sure. Abby, thanks for the update. More from Abby around the opening bell. Let's touch base on the broader markets, go through equities, then bonds, and finish on foreign exchange. About 5 minutes away from the opening bell. Equities elevated by 0.4% yesterday, snapping that 8-day winning streak on the S&P 500. The rally was inspired by a bond market rally. The sell-off yesterday encouraged and fueled by the bond market sell-off. The 30-year with a big move higher on a yield yesterday. The 30-year this morning lower by 4 basis points, 4.72. On a 10-year, we're lower by about 5 basis points at 4.58. Coming up, RBA's Dan Suzuki seeing mounting reasons to buy this equity market. That conversation is coming up next. Your opening bell is just around the corner. 24 seconds away from the opening bell this morning. Good morning. I think we all needed a quieter morning, didn't we? We've got one so far. Equity futures on the S&P 500 positive by 0.5%, bouncing back from the first day of losses for the month of November after snapping that 8-day winning streak on the S&P. There's your opening bell. Switch to the board and get to the bond market at the epicenter of your hopes and dreams, your fears and nightmares. Yields lower by 4 basis points this morning, 4.58 on a 10-year yesterday. Yields double-digit moves across the curve, 2s out to 30s. We had the first close north of 5% on a 2-year for the month so far. Now we're back below that level on a 2-year yield, lower by 3 basis points to about 4.98, 4.99. With that, the euro showing some strength against the weaker dollar, 106.84 on that currency pair, positive by 0.1%. Crude still in the 70s, but higher this morning by 1.5%. Let's call it that, round it up, $76 and about 86 cents on WTI crude. About 30 seconds into the session, equities look like this, positive by 0.4% on the S&P and just about positive now, I think, on the week as well. On the Nasdaq, up by 1/3% on the session, about 45 seconds in. One stock to watch at the open, Wynn Resorts. Shares moving sharply lower on weaker than expected numbers out of Macau. The CEO highlighting the positives, saying this: the recovery in Macau continued throughout the quarter with particular strength in our mass gaming, luxury retail and hotel businesses. Abby has more. Hey, Abby.
Hey, John. Well, it's interesting because there's so much going on on here. So relative to those comments about Macau, it's Barclays is saying that the margins and the commentary were actually disappointing, yet saying that the Macau numbers beat. Now, relative to the overall surface numbers, it was a big beat, yet we have the stock down the most since October of 2022. I was mentioning tons of laggards before. This is one of them, a well-known casino operator. They beat earnings by 33%. They beat revenues by 5%, $1.67 billion. So not small numbers. But it has to do with Macau, because Las Vegas, those numbers were very strong. And analysts do seem to agree that the commentary, the look forward on Macau is what's disappointing. We've been hearing a lot about luxury spending and the consumer in China slowing down to some degree. This could be certainly a piece of it. Macau just 19% of their revenues, but even so, something else to keep in mind here, John, the stock on the year up, it is higher by, about 9%, and yet there's a 7% short interest, so those bears creeping in. And then one other piece of news, of course, the Las Vegas strike was averted as Wynn Resorts is one of the last to round out the labor deals there. So lots going on, but one thing is clear, Wynn Resorts, the stock right now, the worst day in more than a year, down about 8%.
Close to 9% now. Abby, thanks for that. 82.92 in early trading. Let's turn to the autos. Tesla looking to rebound from its worst day in nearly a month. This after President Biden supported the UAW's push to unionize their employees. Ed Ludlow tracking this one. Hey, Ed.
Yeah, John, trying to rebound is the right way. We're basically flat on the stock, maybe softer, 0.1%, but technically down for a third straight day. There was kind of a confluence of factors Thursday when Tesla was the biggest points drag on the S&P 500. The biggest factor being, as you said, Biden saying he, quote, absolutely supports the UAW's effort to unionize Tesla, but also name check Toyota. I know you tracked that spike in yields Thursday as well, and then you kind of come back to the Tesla story and what it is. It is a risky growth stock and is impacted by both the rates narrative and some sensitivity to yields. There was a beautiful sell side note out that I wanted to read you. HSBC initiated the stock with the sell equivalent, saying our caution stems from the uncertainty around the timing and commercialization of Tesla's varied ideas. I think there's just a lot going on with Tesla that might happen in the future or might not, but we're on a sustained downward trend since earnings, where Elon Musk did bring up the impact of higher rates.
A beautiful south side note. Ed Ludlow, thank you. That stock positive by, let's call it 0.2%. Let's turn to media, shall we? Lionsgate, News Corp, both topping estimates. The Lionsgate CEO saying this: we are reaffirming our guidance for the full year, even with the negative impact of the strike. Simone Foxman has this one. Hey, Simone.
Hey, John, yeah, and if you want to put a figure on the impact of that strike and its resolution, you only look at Lionsgate earnings. So Lionsgate coming out around just after 4 p.m. after the close of trading yesterday, but we didn't get the call until about an hour later. Shares didn't move immediately until the call. And one of the things we heard on the call was that the impact of the Hollywood strike would be less than initially anticipated. The executives there pegging that at approximately $30 million. So seemingly a result of what happened in that Hollywood strike. More broadly, though, we're looking at media companies leaning heavily into the digital transformation in the space. Lionsgate, for example, has invested heavily in Starz streaming, despite pretty substantial costs, but at least in this latest quarter, able to not just surprise profit, with adjusted earnings per share coming in at 21 cents versus an estimated loss of 7.5 cents per share. Motion picture revenue up about 77% year on year. When you kind of contrast this with News Corp, gone a very different direction, looking a lot these days like the New York Times instead, but they were able to beat as well, an adjusted earnings per share coming in at 16 cents over the 12 cents anticipated, led by that Dow Jones Digital Network. This is really important, though, by Starboard, because Starboard Value has taken a larger position, wants to make strategic changes, especially perhaps spinning out the real estate unit, which actually looked a little bit better than most people anticipated. So both media companies in the state of transition, but only one having this Hollywood strike catalyst, and maybe that's why we're seeing shares of Lionsgate up today of over 5%, while News Corp down over 1.5%.
Simone, thank you. The latest on Lionsgate and News Corp there. Check out shares of Groupon. You know a stock is facing some trouble when you're down about 32% and it's not even your worst day of the quarter. That's where the stock is right now, falling as results miss and the co-founder resigns from the board. The interim CEO saying this: while we did not make as much progress on key projects as I expected and our business continues to be challenged, I am pleased to see sequential improvement. Katie, your challenge to explain this one. Morning.
Well, I'll tell you, it's a bevy of bad news for Groupon, which, if you don't remember, it's basically a website for finding group coupons, get it, to restaurants, local events, etc. It also reported earnings yesterday. It did not go over too well. The adjusted loss per share was 12 cents. The estimate had been for an 11 cents loss per share. So adding to that, as you mentioned, you also had Groupon's co-founder announcing his decision to resign as a member of the board effective that day. And finally, Groupon also announced a plan to raise about $100 million through an equity rights offering, which might explain why the shares are down almost 32% at this moment. Barclays noted that equity rights offering, it's likely going to weigh on the stock and that shares could also remain under pressure. Quote, recovery expectations are getting tempered a bit. So you add it all together, like you said, this is only Groupon's worst day in about a month, though I will note that through yesterday's close, the stock was higher by 58% this year. So it's going to be one to watch.
Volatile, that's for sure. Katie, thanks for the update. Here's your update in the broader markets. 7 minutes into the session, we're just about positive on the day, just about unchanged on the week. We're positive by 0.25% on the S&P 500. On the Nasdaq 100, bouncing back by about 0.5%. Dan Suzuki of RB Advisors discussing the rapidly shifting narratives in markets, writing this. A few weeks ago, interest rates were hitting 16-year highs, and the equal-weighted S&P 500 was about to fall back into bear market territory. What's changed? Modestly better issuance outlook from Treasury and some softer economic data. Dan, I'm pleased to say, joins us right now. Dan, call it what you will, and great to catch up with you, buddy, as always. We've called it narrative roulette, narrative table tennis. Dan, what explains the shifting back and forth between things are great, things are terrible, things are something in between?
Well, I think, nice to see you, John. I think, part of it is explained by just the changing narrative, changing makeup of the market. I think, the quick, quantitatively driven, algorithmically driven, players in the market cause wider swings, so you get these bigger amplification of moves in the market. And then there's just the overall sort of aspect that we are late in the economic cycle, not late in the profit cycle per se, but late in the economic cycle where it's just a tricky time. Better growth means a tighter Fed, and slower growth means you might be going through a recession. So I think the market just in one extreme to another, whereas if you look at the actual underlying fundamentals, it's not moving that rapidly.
Dan, you get some softer data, and you know what people start to say: it's not too hot, it's not too cold, it's just right, it's Goldilocks. Is Goldilocks a moment in time, or do you think it is the ultimate destination, a condition we'll have to live with for a while?
Jonathan, I think Goldilocks is a moment in time. I mean, look, if you look historically, rarely is there any time where you just sort of consistently in a steady state. Typically things are getting better or they're getting worse, and you go through these cycles over time. And that's why they're called cycles, economic cycles and profit cycles. And so, Goldilocks, where you're sort of at this intersection of different aspects where inflation is coming down and lags, and growth, is picking up, but also, hasn't really re-accelerated yet. And so I think, that's probably where we sit today. We're late in the economic cycle. So as we get, later into next year, growth is really holding up well, and perhaps accelerating, then we're going to have to contend with potentially a tighter Fed than people expect, especially when they priced in more cuts.
You've done it twice now. You've drawn a distinction between the economic cycle and a profit cycle. Can you explain that a little bit more, and how you think that's going to track in the coming 12 months?
Absolutely. I think this has been the big distinction. I mean, if you just look in the backward, in the rearview mirror here, I mean, we just got the GDP print for the third quarter. Nominal, growth was like 8.5%. Meanwhile, if you look at profits growth, this third quarter came in better than expectations. It's basically, year over year. By most accounts. And so, there's been this distinction of a profits recession and pretty stable economic growth. And I think that's, what people don't realize is that is a disconnect going forward. We are early in this profit cycle recovery. We think the jury's out there. The profit cycle, troughed, at the end of last year, and it's been trying to steadily recover here. But the economic cycle is already, there's less likelihood of a huge surge in acceleration from here. So that's kind of what you have to contend with, is just this continued disconnect between the profit cycle and the economic cycle.
In the meantime, Dan, how do you want to play that? If you want to play that profit recovery cycle, how do you want to play that? Where in the equity market?
Well, I think typically what you want to go do is you want to go buy cyclicals, right? Because the cycle, the profit cycle is determined by the cyclicals. And so whose profits are going to accelerate the most and benefit most from that environment? It's the cyclicals. And if you look today, there's two types of cyclicals. There's expensive, crowded cyclicals and cheap cyclicals. Well, we contend that you want to own the cheap cyclicals because as growth becomes more prevalent and more companies have stronger growth, then the company investors can become comparison shoppers. And they can look toward cheaper areas, access to that improving growth outlook.
Is this the argument for the equal weighted S&P then?
Yeah, I think that's one way to play it. I mean, our view, and you know this well, is there's one crowded, expensive part of the market. And if you look everywhere else, you could throw a dart at a dart. Thing out there is cheap, and so a lot of that stuff is cyclical. It's international, emerging markets, value, small caps, all that stuff. I think is very much going to benefit from the dynamic we're talking about.
I've heard that a lot from you, Dan, all year. So I've got to push back a little bit because why can't the expensive stuff just get more expensive? And can you really miss out on some of these gains we're seeing in big tech? I look across the screen, as you know the numbers anyway, but for the people that don't, Nvidia's up more than 200%, Meta's up by 167% year to date. Dan, why shouldn't I just stick with the things that are winning, the things that have done well?
Well, I think if you follow that recipe historically, I mean, you do well, momentum works until. So I think, the issue here is that I think that the underlying macro fundamentals have shifted. I think over the long term, we're going to be dealing with, higher inflation, more higher interest rates. And I think that's going to be a headwind for some of these more expensive names. In the near term, I think, again, as I said before, as growth reaccelerates, I think a lot of these companies will see their growth accelerate as well. It's just, investors will become comparison shoppers. Why pay 30 or 40 times for companies who are going to put up X amount of growth when you can buy companies that trade at a fraction of that multiple that will give you better access to better growth? So I think that's just a normal cyclical dynamic. So the difference is we're at this inflection point. 6 months ago, growth was very, very weak. And so you could flock to the companies that had, very, very good growth prospects. Now growth prospects are improving everywhere. And I think that's the difference now.
Dan, appreciate the clarity. Always do. It's great to get an update from you and the team. Dan Suzuki there from RB Advisors. The broader market right now looks like this. About 13 minutes into the session, we're positive 0.4% on the S&P, and the Nasdaq up by about 0.6. Coming up, President Biden gearing up for a high-stakes meeting with China's Xi Jinping.
The United States has no desire to decouple from China. A full separation of our economies would be economically disastrous for both of our countries and for the world.
Remember, decoupling, that's unacceptable. You have to say things like diversify. We're looking to diversify. Team coverage from Capitol Hill up next.
The United States has no desire to decouple from China. A full separation of our economies would be economically disastrous for both of our countries and for the world. We seek a healthy economic relationship with China that benefits both countries over time. The United States will continue to take targeted actions to protect our and our allies' national security.
Secretary Yellen setting the stage for a highly anticipated meeting next week. President Biden sitting down with China's Xi Jinping for the first time in a year, looking to maintain America's role on the international stage while also supporting two military fronts abroad. It's a tough balancing act entering a re-election year as a new Bloomberg poll reveals key voters are more concerned about domestic issues, with 68% of respondents saying they approve of funding for border protection, a larger share than the 61% who back aid to Israel or the 58% who favour aid to Ukraine. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons down in Washington, D.C. AMH laying the groundwork, Secretary Yellen, for President Xi Jinping and President Biden next week.
Yeah, Secretary Yellen made it clear, as she has done a number of speeches, Jonathan, that these economic tools, they will be used by the United States to protect national security. Now, her counterpart, Ho Feng, is talking about the fact that they want to make sure China and the United States get back on track when it comes to trade. Remember, the cloud over all of this for Xi Jinping, as he doesn't just sit down with the CEO of America Inc., but he sits down with other top executives of American business, is he's trying to make sure that China stays open for business because they are dealing with an economy domestically that has a tremendous amount of issues. But Secretary Yellen setting the stage. But Jonathan, the list of agenda items is going to swell when President Biden and Xi Jinping meet. First, they want to get their military contacts back on track in terms of those discussions. Remember, that was completely ripped apart when Nancy Pelosi went to Taiwan in August of 2022. They also want to bring up issues like human rights, fentanyl, and obviously the two power struggles we're seeing in the world right now, in Europe and in the Middle East.
This is important, arguably the most important relationship on the planet. Yet, Katie Lyons, it is not the top concern for swing state voters in America. Just 1%, according to our poll, said U.S.-China relations were their most important issue.
Yeah, this Bloomberg Morning Consult poll reveals that voters in these 7 swing states are much more focused on domestic issues than the ones that they face abroad. As you said, John, the majority of them support more funding for the U.S.-Mexico border than they do for the conflicts in either Israel or Ukraine. And what also might be problematic for President Biden, who has tried to be the America's back president, go back to being a globalist nation rather than the isolationism that dominated under former President Trump. The majority of these swing state voters actually think they trust Donald Trump more to handle Ukraine and Israel than they do Biden. So that is problematic for a president. Of course, overall, in these 7 swing states, Trump leads Biden by 47% relative to Biden's 41%. This is problematic, assuming that this is the 2024 matchup. Right now, these are the presumptive Democratic and Republican nominees. Things could get a little bit more interesting, though, John, especially in light of the announcement yesterday. Senator, the Democrat from West Virginia, Joe Manchin, announcing he is not seeking re-election in 2024. And not only does that potentially disrupt the math in the Senate, mean it may be harder for Democrats to retain their very narrow majority in that chamber, it also could theoretically set him up to pursue the presidency himself or potentially the vice presidency. He, of course, is affiliated with No Labels, an organization that has said by early next year they will decide if it's looking likely to be a Trump-Biden rematch in 2024, whether or not they will run a unity ticket. They said yesterday in a statement in light of Manchin's announcement that they haven't made any decisions yet on if they will run a ticket or who will be on that ticket. But there's certainly been a buzz here in Washington in the last 24 hours, John.
AMH, just to pick up on that, if it's a Trump-Biden rematch, still an if at this point, what does the president do about these numbers in our poll this morning? They say they trust Donald Trump to navigate the Israel-Hamas war more than Biden, 44% to 31%. And preferred the former president more on the Russia-Ukraine war as well, by an 11-point margin.
These are challenging numbers for the White House. I mean, if you're the campaign, you're looking at these numbers. And, Jonathan, this is our second set of results. And for the most part, they're in line with what we saw last month as well. These are the states where elections are won and lost. And, Jonathan, they do not look good for this president. When you have a name like potentially Joe Manchin circling around, that would take votes from Joe Biden. One interesting part of this poll, and this is new to this month's poll, is we asked about RFK. And, Jonathan, he's taking 10%. But with RFK, it's not just from Joe Biden. He's also taking from former President Trump. But what it does show, our poll, 10% from RFK and some others floating around, 19% of these swing state voters want someone else. They're called double haters. They don't like Trump and they don't like Biden.
Interesting. AMH, Katie, to the two of you, thank you. For the broader price action, we're about 23 minutes in. We're positive 0.5%. Let's get you some sector price action. Here's Abby.
Well, John, we're looking at a broad-based rally today. Most of the S&P 500 sectors are higher, supporting that gain. Tech up the most as yields are lower. Valuation looks more attractive. Energy the second best, up 0.7%. To the downside, we have consumer staples and healthcare. On the week, it's going to be right down to the close. Right now, the S&P 500 up about 0.2%. Most sectors are lower. In fact, at this point on the week, just 2 sectors are higher. Tech and communication services, not surprisingly, energy down 4%, with WTI crude, of course, back below $80 a barrel, even though higher today.
Abby, thank you. Up next on this program, your trading diary. trying to bounce back here on the S&P, up by 0.5%. That's the price action this early Friday morning. Let's get to the trading diary. Things shaping up as follows. Secretary Yellen speaking at 3 p.m. Eastern. Then next Tuesday, more Fed speak from Goolsbee and Jefferson. Plus, we'll get US CPI. Wednesday, PPI figures. Plus, President Biden expected to meet with Chinese President Xi Jinping in San Francisco. Thursday, Macy's, Walmart and the Gap report earnings. And Friday is the deadline for Congress to avoid a shutdown. That conversation is just around the corner. That does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.